COMEX futures prices and open interest are sending a message. Let's take a look at gold futures first. Notice that most of the open interest is concentrated in the April contract. It's interesting that the price of this contract is actually slightly lower than the spot price. Why do I say it's interesting? Well, it means that someone who actually owns good delivery bars on deposit at the COMEX warehouses can sell their gold to someone for cash. They could then turn around and use a portion of that cash to buy on margin the same quantity of gold bars to be delivered in April. When you think about it, this is something that the owners of gold bars would be motivated to do. After all, the price of the April future is a little lower than the spot price, so it costs very little to mobilize gold in this manner. The only cost is the margin rate on the futures contract and the bid-ask spread on the gold contract. The cash made available from this operation could then be used to lend at interest. So why aren't more gold owners decarrying their gold for a profit? There are only a couple of things that would deter the owner of gold from mobilizing his or her gold for a profit. One would be a lack of trust in the futures market. If those who own the gold are skeptical that the April contract can perform and return their gold to them, then they would be disincented to decarry it for a profit. Another possibility is that the rate of interest available in the cash lending market is too low for this to be a profitable exercise. Now, I think both of these are entirely possible. The latter, though, is more probable in my mind. If you take a look at the open interest in the chart in the lower right-hand corner of this page, you will notice that the total open interest of all contracts peaked in early 2020 at a little over 750,000 contracts. Now the total open interest is a little over 500,000 contracts. And coincidentally, the 2-month LIBOR rate was 1.8% in early 2020, and now it's only 0.15%. The large decline in intrabank rates is disincentivizing gold to mobilize, and so gold is going into hiding. Not literally, mind you, but figuratively. It's not being offered as readily as it once was when interest rates were closer to 2%. Now on to silver. We can see that the majority of concentration is in the May futures contract. Notice it again is very close in price to the spot price. One would expect the owner of silver bars would want to decarry so that they could generate some interest on their holdings. Why not do so? Why is the open interest lower than it was in early 2020? Again, it has to do with the LIBOR rate. In early 2020, the 3-month LIBOR rate was 1.9%. Now it's only 0.2%. The interest rate just isn't enough to incentivize the owners of silver to mobilize their silver. So silver too is going into hiding. All that said, there are two possible outcomes from here. The first possibility is for interest rates to climb and climb significantly. The second possibility is for paper and physical prices to continue to diverge. After all, lack of available metal meeting a willing and eager demand will put pressure on the price of the retail metal. Stay tuned, folks. This is going to get interesting.